If this is your first time here, welcome. During our shows, we interview successful entrepreneurs and investors to spread knowledge, advice, and actionable tactics to help others in the pursuit of financial freedom. We discuss successes, failures, systems, motivations, experiences, and key lessons learned along the way in the hopes that these stories help you along your journey. Tune in every Wednesday to get your weekly juice. If you've been here before and like what you've been hearing, please subscribe, share with friends, rate, and leave a review on Apple Podcasts. That goes an extremely long way for us. It's simple. Just click on your podcast app, type in our podcast name, The Weekly Juice, click on the reviews, and let us know what you think. The more ratings we get, the more eyes we'll get on our show, and in turn, we'll be able to provide you all with high-quality guests. You can also find us on Instagram at Weekly Juice Pod for daily content and personal finance tips to assist in your journey towards financial freedom. Welcome back to the Weekly Juice. Ryan and Corey here with another episode for you. Today we have episode 39. Special guest on today's show is Jeffrey Holst. Jeffrey is a seasoned real estate investor based out of Chattanooga, Tennessee, with a portfolio of over 250 units. He's an author, public speaker, coach, and also a podcast host.
I'll tell you what, man, we just got done recording. This guy has so much knowledge in his brain and he talks so fast. He's just spitting knowledge at us all day. Like, if you guys want to know the definition, his specific definition of a 1031 exchange, how it actually functions in real estate, how syndications actually function, what do they do, what type of lawyers do you need, maybe some resources to find these lawyers, how to build small or buy small multifamily, how to build it up to larger. I mean, He's done it all, and not to mention his incredible story, literally near-death experience. Like, he had leukemia and thought he was going to die, bankrupt, nothing, like had nothing, clean slate, and then built his portfolio after that. I mean, doesn't get much more inspirational than that type of story.
The first half of the episode is mindset, and he shares a story, and then he brings us to this, I guess, like pivot point when he figures out he has cancer and that he wants to lead a different life and starts talking about his bucket list. And just absolutely incredible story. I really think everyone's going to enjoy it. So let's dive in and start today's episode.
So let's do it.
Welcome to the Weekly Juice. We are super excited to have you.
Thanks. I appreciate being here.
Cool.
Absolutely. So if you could just give a little background on yourself, who you are, where you're from, how you officially became an entrepreneur, and why you got into real estate.
Yeah, that's a little bit of a long story, but sure. So I didn't, like most people, didn't really know what I wanted to do with my life. So I was working at a 7-Eleven back in 2001, 2000, something like that. And I just didn't know what I wanted to do with my life. So I was sitting in a college class listening to this professor talk about Michelangelo's Moses. And this is a sculpture that's like, it's the centerpiece of Pope Julian II's tomb, right? So I was hearing him talk about how during the unveiling of this, he stood in front of the Pope and kind of went nuts. And he ends up throwing his chisel at it and screaming the word move. And, back then the Pope was like, it'd be like if you had the president of the world, all the world leaders wrapped into one. So I was thinking to myself, man, there's nothing I'm so passionate about in my life that I would go insane in front of the most important person in the world. So I thought, I just got to see that. So I dropped out of school. Literally, I finished that semester, took all of my money, and I went to Europe, and I wandered around Europe with a backpack. And I finally get to Rome, and I go up to see this sculpture, and I get into this little church, and it's on a hill overlooking the Colosseum. And I'm like, all right, this is going to be like life-changing. It was like my Indiana Jones quest, right? Like, I'm going to go discover this thing. And I went in there and I was like, it's okay. It's a sculpture. I mean, I've gone back since, and it's actually a really cool sculpture. But it didn't change my world. So I walked out of the church and I sat down on the front steps, and I was young and dumb. So I was smoking back then. So I started smoking a cigarette, and I'm looking down at the Coliseum, and I'm like, man, I like seeing old stuff. I don't know anything else about my life, but I like seeing old stuff. So I'm just going to go figure out how to make some money. And I'm going to go travel the world and see old stuff. So I made a little list: the pyramids, Machu Picchu in Peru, Petra in Jordan. I made this little list in my head, and I just I just proceeded to do that. I knew my dad was a lawyer, so I went, I'm going to be a lawyer. Lawyers make money, and I can use that money to go see the world. So I went to Egypt and saw the pyramids, and I went to Jordan and saw Petra. And finally, when I was 30, I went to Machu Picchu in Peru. And by then I was a lawyer, bankruptcy attorney. I had 2 attorneys that had worked for me. One quit earlier that summer, so I was down to like one other attorney working for me. We even had a television commercial, and this is 2008. So if you can imagine, bankruptcies in 2008, that was a hopping business, right?
Yeah,
like we were doing pretty well. So it's kind of like way up on the top of the world, and literally and figuratively, because like figuratively I was doing really well, but then I went to Machu Picchu, and you climb up to the cloud forest looking down at the Incan city, and kind of had that same sort of feeling that I had when I saw the Moses, right? I'm looking down and I'm like, now what do I do? Like I just checked the last thing off my bucket list, and I was kind of like, I said to my wife, I'm like, I don't know what to do now. Like, I guess I'm just going to go back and practice bankruptcy law and make some more money and figure something else out. And I went down the mountain. I got a voicemail. This is pre like international cell phone. So I called on the payphone, and it was from that other attorney. And he was like, I'm giving you a 2-week notice. And so he had given it to me like 4 days earlier. So I had like a week, right? Notice in reality. Yeah. And then I flew home and thought, okay, well, I'm gonna have to hire someone because I can't do the work of 3 attorneys myself. We were already down 1, and I was feeling really sick when I got home. And like 3 days later, I was diagnosed with leukemia.
Wow.
Yeah. So I literally went from like doing awesome, having achieved everything on my personal bucket list, to laying in a hospital bed, dying, and on my way to personal bankruptcy in less than a week.
And like, I'm not a doctor at all, but getting diagnosed with leukemia, like,
you don't want to do it. That's the answer.
You definitely don't want to do it. I know that, but I'm thinking like, how did that happen? Like so quickly, and then all of a sudden you're very sick. It seems insane.
Yeah. So a couple things. One, leukemia is a white blood cell condition. It's a bone marrow condition that causes your bone marrow to overproduce white blood cells. Yeah. So white blood cells are really important for like fighting disease, right? And so part of your immune system is based on that. The type of leukemia I have is called CML. It's chronic myeloid leukemia. There's 2 phases. There's like a normal phase, and this is where it just slowly creeps up over time. And then it goes into a blast phase where your white blood cells just jump like crazy. Blast phase is like when you're getting close to death, frankly.
So you got home and you were immediately sick.
So I went up into the mountains, right? And white blood cells count was really high. It didn't have a lot of symptoms. I mean, I was a little fatigued, but I thought I was just getting old and lazy, right? Like, and get out in the mountains, and I got really sick, altitude sickness, and I just felt like crap, and I developed pneumonia a little bit. I mean, it wasn't like a terrible case of pneumonia, but I had a cough and was diagnosed with pneumonia. But what it really had happened is your red blood cells are how you move oxygen around in your body. And Sherpas in like the Himalayas have elevated red blood cells. They're like adapted to be better at elevation. Well, I had the opposite, right? I had way, way high white blood cell count, which was suppressing my red blood cell count. So when I went to elevation, I got very sick. And that's sort of what triggered a rapid change in my health. Yeah, I mean, it wasn't that I was significantly more sick one day to the next. It was just that like it was really obvious at that point. And my white blood cell count was 258,000. I don't know if you guys know anything about that, but it
sounds very high.
Yeah, it is. It's supposed to be between 4,000 and 10,000.
Holy shit. Okay.
Yeah. And the only thing, so let me finish this one thought a second. The only thing I knew about white blood cell counts was I had a cousin who had died a couple of years earlier of a different type of leukemia. And her white blood cell count when she died was 150,000. And mine was 258. So I was like, I'm dead. Like literally, like when they told me that, they're like, I get a call from a doctor at 10 o'clock at night. Hey, no easy way to tell you this, but you have leukemia and you have to go to the hospital right now. Like right now, like drop what you're doing and come straight in.
Oh, wow.
Yeah, because I'd gone to a med center like in the morning and they'd done blood work. And when they got the results back, they were like, we can't wait to tell them like on Monday, like we have to call right now and get him to the hospital. Because this is like way outside of the normal range, like, 50 times where you're supposed to be.
So I'm just trying to put myself like framing your mindset. So forget about business, forget about entrepreneurship, forget about law. Like you're now at a state where you don't think you're going to survive. So like what happened after that and how did you come out of this? And it sounds like you came out of it with a completely new like frame of mind. Like, so
you might not believe this, but when I was 17, so I was 30 then, so it's the 13 years later. But when I was 17, I was kind of depressed, teenage angst kind of stuff. And I made a decision never to have another bad day. I just said, I don't have bad days. I just kept saying today's a good day over and over and over again. And I said it for like months and it frankly didn't really work. But after a while, all of a sudden I realized I was just always having good days. And I had this like unbroken string of good days that had lasted at this point, like 13 years. So I'm in the hospital. I'm thinking I'm dying, right? I literally, like my dad said to me, this is in September. He said, if you live till February, I'll take you to Australia. And my answer was, I just hope I make it to Christmas. Like I want to say goodbye to the family. That's where my mind was. And my brother came in that night and he said, I bet today's a bad day. Like he almost wanted to prove that it wasn't possible to always have good days. And I was like, no, actually, I got diagnosed at 10:30 at night. Like most of the day was good. So in my mind, I was like, it could have been worse. Like, I could have been diagnosed in the morning. And then that next day, right, I'm in the hospital all day and I know I have leukemia and I think I'm dying. Like, it turns out I wasn't, which is great, obviously, but we didn't know that yet because we had to do, more testing and all sorts of other stuff. And it's like 4:00 in the afternoon and I was struggling. That was going to be a bad day. I mean, I was telling myself today's a good day, and just wasn't feeling it. And my wife is upset. And then she left actually to go to the restroom or something. And there was a change of staff and this new nurse came in and she walks into the room and she looks at me and she says, "Oh my God, Jeff, I'm so sorry to see you here." And I recognized her immediately as a childhood babysitter of mine. And my response is, "I'm so happy to see you." Right? Like, I'm so happy that I'm here because I get to see this babysitter that was one of my favorite babysitters when I was like 7, right? So it's been like 25 years or something like that, or 20 years since I'd seen her. And it clicked to me, today's actually a good day. Like I get to see Shelly right now. And I think that sounds weird and most people don't believe it, but it's kind of like when you get a new car and all of a sudden your neighbor has the same car as you, right? It's not like they went out and got it that day, but your mind, there's this thing called the reticular activating system, right? Tony Robbins talks about this. It's your mind basically defaults to what's familiar. There's science behind it. It's called the Bader-Meinhof phenomenon. But basically what I think happens is if you make yourself in a situation where you're constantly having good days and you're constantly looking for positive all the time, and you just have this like relentless positivity in your life, then your mind defaults to the familiar. And the familiar for me is today's a good day. And I'm always looking for something positive. And you could say, well, that's just tricking yourself or what? Well, who cares, right? I mean, does it actually matter if you're just tricking yourself? I had a good day that day. And in retrospect, you kind of alluded to this, like you come out of these kind of experiences completely different. That actually was probably a pivotal day in my life. Like that's when I decided I don't want to practice law. I was doing that for the money, and you shouldn't do things for money. You got to do things you love, right? And if you're doing something for money, it better be to buy back your time so you can do what you want. Right. And that's when I started thinking about real estate. Really, I mean, honestly, in the hospital bed going, I should have been investing in real estate. Like, honestly, I was like, because I'd read, Rich Dad, Poor Dad 10 years before that. And, I'd watched.
So it was in your mind. You knew it.
Oh, yeah, man. Yeah. I had the Carlton Sheets, like, infomercial course. Like, you guys might not even remember that guy. But he had this no money down late night television infomercial. You could buy a CD set. I had done all that stuff. I mean, I even bought the Cash Flow 101 board game when I was in law school. And we used to play that all the time. So, I mean, I was like, it was always someday I'm going to invest in real estate. And then when I was sitting there thinking I was going to die, you get that sort of, you hear people say this, right? You didn't want to be on your deathbed thinking, oh, I should have done this, and regretting the things you didn't do. Well, that's exactly where I was. I was regretting the things I did.
It's a scary thought at 30 years old.
Oh yeah. Well, you don't plan
at any age. Right?
Yeah, you don't plan it at 30, but like I said, not only did it feel like a good day to me, in retrospect, it's probably the best day, because it's the day that I went, oh, I'm doing this all wrong. Like I have to, if I get through this, I have to live a different life. And that different life was, I quit my practice. I closed it down. I ended up filing personal bankruptcy, as a result of the medical bills and not having attorneys that would work for me when I had expenses at the firm and stuff. And and actually that day was almost harder than when I got diagnosed with leukemia, because it felt kind of like failure. But same thing, my subconscious mind found something to be happy about. I had the worst trustee. So when you go in, I shouldn't say this because he'll probably listen to your show now, right? But when you go in front of a bankruptcy trustee, they assign them randomly. There's in each district, there are several. In the district that I practiced law in, there were 6 of them, 2 of which I didn't really like, 4 of which I thought were really cool. I mean, were friendly. And 1, which I was kind of terrified of. I tried to so I hired one of the 2 that I didn't like to be my attorney. So there was no chance that she would, she's probably watching your show too now and knows why I hired her, but hey, whatever. There was no chance she could be my trustee because she was my attorney. Right. And so I figured I had a 1 in 5 shot of getting the trustee I didn't want. And as luck would have it, I did get that trustee, right? And I'm nervous, and even though I know what's going to happen, because I've literally done these hearings hundreds of times from like 1 seat over, I'm freaked out because this trustee is going to he's just going to stick it to me. I know he's going to. And we sit down, and he always started the same way, and he stops the recording. There's a little recording. He stops the recording, and he looks at me and he says, "Jeff, I'm really sorry to see you here." And I was like, holy cow, this guy's a human being, right? Like in that, to me, it made the whole day worthwhile, because I was like, wow, this guy just said something kind of nice to me. And like, that was enough to make that a good day for me, because it was like a personal victory, because I always wanted him to be friendly. And the weird part is, like, I'm Facebook friends with him now, and like, he's nice to me. And like, I mean, it's really weird how the world works. But the thing is, that bankruptcy, also a really pivotal point in my investing career, because it forced me to get super creative, right? Like it's 2010. I have no money. I have no credit. And I just took a job making $600 a week, and I want to be a real estate investor.
Yeah. Blank slate. It's just a blank slate.
No, I mean, actually negative net worth, because I still had my law school debt, right? Like, because that doesn't go away in bankruptcy. So I'm like negative 100,000 in net worth. I moved from Michigan to Chattanooga to take this job because I need better benefits. That's the real reason. And also, I wanted to complete start over. And, from there, that was 2010. By 2017, with my partner in Michigan, we'd actually bought like 50 single family houses and condos and a couple of duplexes. So we had around 50 units. And then when the company I was working for was selling out to a bigger company, I got like 6 months severance, and I'm like, I'm not going back to work. Like, I don't have to.
So I know your portfolio now is like roughly 250 units. Is that correct?
Yeah, it's getting close to 300. I mean, we're always adding. I have 30 under contract right now. So.
And that's awesome. So you talk about that bankruptcy, and then those years where you went to 50 units. Can we talk about like how you even but there's one thing to decide you want to get into real estate. There's another thing to like actually do it. So
it's super hard, right? So I had a friend in law school who we played cash flow together, and he was flipping real estate in Detroit, and I was living in Tennessee at the time, and he was doing pretty well. And I said to him, hey, if you're gonna buy something, buy and hold. I've saved up a little bit of money. It wasn't a lot. It was like $17,000. But remember, this is the bottom of the market, right? So it's good timing, fortunate timing, because I wasn't like anything of my own that I happened to be at that point. But he had this deal. It was a condo in Birmingham, Michigan. And it's like Birmingham's like a ritzy suburb of Detroit. And it was a bank-owned foreclosure that had the mortgage that they had foreclosed on was $105,000. And we bought it for $30,000. So we just paid cash for it. So it's like I put in 17, he put in 17. We started a company, 50-50 ownership in the company, and we had $4,000 left in the bank.
That's really funny. That's how you guys got started, because Ryan and I formed a 50-50 partnership. I mean, a little bit different. Neither of us were on our deathbed before we did it, but we. Well,
I wasn't anymore either at that time. So.
Right, but I'm saying, just good friends, and it's interesting that that's how you got your start. Yeah. So that's cool.
No, and it's been fantastic. I mean, and then shortly after that, we had another deal come up. It was in the same building. I didn't have the money. He loaned me half the money to get into that deal. I've since paid him back, but that formed the foundation. I mean, those two condos, they're probably worth $125 now a piece, and we still own them. We later got little mini mortgages on them, so we owe like $50,000, on each one or something. But we just used that money to buy something else, right? And that was a private money loan originally. We put $25,000 on two different condos, and then we had a third partner put up another $25,000. So we ended up with $75,000. We bought a duplex, and that duplex, geez, that thing's worth a ton now. It's on a double lot in another ritzy suburb of Detroit, but the market was so stupid then. I think it's probably worth like 300 now or something. And we don't owe anything on it.
Was that your primary strategy? Were you buying just small multis and single families and trying to build it up that way?
Yeah. I mean, that's all we knew how to do, right? I mean, if I could do it over again, the biggest mistake I made in real estate was not starting before I got sick. But the second biggest mistake was not getting to multifamily sooner. I mean, the value add multifamily, and by that, I mean like 5 units and up. It's an unbelievable wealth generator. And I didn't start doing that until I quit working, which is another thing most people don't do, right? They try to build their portfolio first and then quit. And I was like, I don't have enough money to quit, but I'm never going to get there if I don't just like pour the gas on and start buying this stuff. And, big motivator when you don't have any money coming in to start making more money.
Incredible. I'm curious about that shift. Like how much money you must have had. Look, you're a lawyer. Okay. You're probably living a certain lifestyle.
Oh yeah.
Right?
We were doing pretty well.
Pretty well, right? Bankruptcy law in 2007, 2008. And then you just said you weren't making enough money to quit your job. Did you have a shift in, okay, now I got to live in this certain area. I got to how much money were you bringing in when you quit?
So, I mean, actually my salary wasn't that high. No. Yeah. So, all right. So two things. One, I had a pretty good job. Like I'd worked out a deal when I moved down here, to get a percentage of the profits from this company. It was a small company, and we grew it it was a trucking company. We grew from 4 trucks when I moved here to 91 trucks when we sold out. So my little percentage of the profit was like a lot. So I'd put a little bit of cash aside.
Got it.
And I paid off my house. That helped a lot. Right. And so I had that. And then I got the 6-month severance, which wasn't that much because my salary actually was only like 60,000 or 70,000. So I got like 40 grand, something like that. So it was like I had this $40,000 and I had like essentially no money coming in from real estate at that point, which I realize sounds weird, but because we'd always made money, my partner and I had decided we were never going to take any money out of our real estate. So every dollar we got, we just used it to buy something else. So we only ever put in maybe like 30, 40,000 a piece in actual money into real estate. But we had this portfolio that had grown significantly just by, flipping some stuff and using the profits to buy something else and, all that kind of stuff. So, if I had pushed the issue, I could have had cash flow. I never asked for it. And we maybe distributed like $6,000 that year to ourselves each. So, it wasn't enough to live on. My wife had a job where she had some benefits, so that helped. But she made like, quarter what I was making. So it was a big drop down in pay. And I just went, well, I'm going to have to figure something out. So the first thing I did is buy a duplex and flip it. But it was like a BRRRR. It was really a BRRRR. Like we paid 58,000. I did it with my dad. We put like 20,000 in, then we refinanced it and got like a $90,000 loan. So we didn't have any money in. When we took that money that we had, the $90,000, and we put it down on our first apartment complex. So we bought a 12 unit apartment complex, which we've since refinanced and gotten, all of our money back plus some, and still have a bunch of equity in it because the market's been crazy.
Do you want to talk a little bit about that deal? Because that sounds like that was the first deal that you went from the small multis and singles to like, this is buying an apartment complex is a big step.
Oh yeah, no, it was. I mean, so here's what happened. I had a banker that I was friendly with locally, and we used to he used to loan us money to buy trucks, right? So that's how I got to know him. And he was telling me, I was like, I don't know what I'm going to do with my life. Like, I don't really want to go back to work. Like, what should I do? And he's like, you should buy like B-class apartment buildings. I know people are doing really well with that. And I was like, okay, go buy B-class apartment buildings. That sounds cool. So I just started looking for it. I actually overpaid for the first one, right? Like, I don't know what I was doing. I was just like, well, $640,000. That sounds good. You know, it's probably worth like 900 now. So it's okay. Right. But the rents were like $550 a door, something like that. I mean, I think the average was just like around $570, somewhere around there. And now we've got the high rent in the building is $1,100.
Wow.
Like 3.5 years later. We've done a lot of renovation. And I took the same strategy that I took with my partner before. And that is, we're not taking money out until we get it to where we want it to be. So we just started renovating out of the cash flow, raising rents, renovating some more, raising rents, renovating some more. And then last year, right before, well, I guess it was like this year, right before the shutdown, like January, something like that, we were able to refinance and get our original down payment back. But that deal, I'd been talking to my partner in Michigan about buying apartments for 6 months or so. And when I put that under contract, he kind of went, oh, we should be buying apartments. So we actually closed on October 4th for the 12 unit, and then we closed a 19 unit on like October 20. So like we really didn't have a large gap between that. And then we bought a 32 unit. We 1031 into a 32 unit that spring. So we ended up buying 3 apartment complexes in like our first 4 months.
Was that all with proceeds from your business? Like, you didn't raise money at that point?
That's right. Those are all JV deals with just this. So my partner Travis, who's in Michigan, he and I had, we had one other partner involved in our business up there, and so we actually took money out of that business to buy the 19 unit. And then we sold 10 single family houses to buy the 32 unit. So we sold them in a package and used that. And they were free and clear houses. Cause that's the other thing that we did, which, if I were to do it differently, I would probably get leverage. But when I quit working, I had zero loans on any of the real estate. So we had about 56 or 7 units. And I owned either a half or a third, depending on what company they were in. But they were all free and clear.
Got it. Cool.
Wow. So you mentioned pros and cons of single family and multifamily, and then you jumped into, I guess you consider multifamily like 5+. You said that's the sweet spot. Yeah. You mentioned value add a couple of times. What did you do to the specific units to enhance the value? Essentially, I assume you're forcing appreciation. Oh yeah. So, and that's why the 5+ matters, right? Because the way they appraise it is different. So rather than do like a comparable sale appraisal, they do a cap rate appraisal. So if you know the cap rate formula, I don't know if your viewers or listeners know this, but basically if you have 2 out of the 3 variables, you can calculate the third one. And the variables are the net operating income, the percentage cap rate for that market, and then the purchase price or value of the building. So if you can, the cap rate is a market indicator. So if it's like a 10 cap market, that means that the average investor expects if they buy a property for cash, right, no financing costs, that they would make 10% on their money. Now, most markets are more like 5, 6, 7 cap markets right now. Some are like California might 3 cap, there's some really, really low cap rates. But the thing is, because it's an inverse relationship, the lower the cap rate, the more your changes in net operating income matter. So by either reducing expenses or by raising rents, you increase your net operating income, which forces the value of that building up. So, for example, if you had a $100,000 net operating income in a 10 cap market, the building's worth $1 million. Yep. If you raise that 100,000 to 110, it's now worth $1,100,000 because it's just 110,000 divided by 10%. That's how you come up with the value. So we were able to do that with our 19 unit and our 12 unit. Now we've actually pulled out more than our original down payments in both cases in less than 3 years. And what we did is we found
the 12 unit by luck, and the 19 unit by a little bit more strategy. We found deals where the rents were below market, and we were able to force those rents up by doing, cosmetic renovations, really. Another thing I did is I went in and replaced things like, I went to low flow toilets and stuff because it was on a single water meter. So we were able to reduce the water bill from like $900 a month to like $300. And it doesn't sound like that much, but $600 a month, right, is, whatever, $7,200 a year, right? Something like that. And then it really is almost a direct NOI increase because you don't have an associated cost with it after you've done the improvement. Mm-hmm. So that $7,200 a year, ends up being like, at an 8 cap, it's like $100,000 in equity or something like that.
One of the questions that we probably have failed to ask after hearing all this information is, what does that property cash flow make? Maybe what did it cash flow after you did the renovations, and then what does it cash flow today? It's very interesting to hear the numbers on a 12 unit to see.
Yeah. So, I mean, look, I don't really pay that much attention to cash flow. I have this thing about, there's 4 ways you make money in real estate. Cash flow is one of them. It's important. I view cash flow as a measure of safety more than a way to make money. I think you actually make money through appreciation, forced appreciation, amortization, which is the pay down of debt, and then the tax advantages. And the tax advantages in multifamily are like off the chain amazing. Like you get into like cost segregations, and pretty soon you have no tax. I haven't paid tax in 3 years, like 0 federal income tax. And I have made money, I promise. But my tax returns show I've lost money because we get all this bonus depreciation. So, I have a $180,000 loss because I bought an apartment building, but it's a non-cash loss. It's not a real loss.
Right.
So until we sell, we don't have to pay that tax. We can refinance 100 times. We can 1031 out and push the basis forward. So there's a tremendous amount of opportunity. There's why like Trump pays $750 a year in taxes and everyone gets mad at him. And I'm looking at it going, why is he paying so much? Right? Like, what's he doing wrong?
Yeah, I think
he shouldn't have any tax.
There's a misconception with why that even is, but I don't think people really understand.
Right. Yeah. And look, I'm not making a value judgment about whether or not it's right or wrong as a government policy to allow for people to not pay taxes. But the reality is, if you think about taxes as a way to manipulate behavior, and that's really what they are, because if they wanted to just tax us equally, they just print more money, because you can't avoid that, right? It just creates inflation. It's an equal tax on everyone. Instead, they create a series of incentives, like if you buy a house, you get to write off the interest on the mortgage, right? Because they want to encourage home ownership. It's the same thing with if you have an apartment complex and they have bonus depreciation that they build in, and they say, we want to encourage people to provide affordable housing. So by doing the things that the government encourages you to do, you get tax advantages.
Yeah, if there's incentivization, we talked about this with a couple of guests. If there's incentivization, if like, the Stealthy Rich, they said the government chooses winners and losers in certain businesses, right?
Yeah.
And if they've chosen real estate as a winner, so why not take advantage of
That's that? Exactly right. Yeah.
Yeah. And now I framed it. I'm like, if our money runs, or if our world runs on this currency, and the currency is controlled by the government, why would we not try to take advantage of the advantages that they give to the people? So
and we can make a policy judgment about whether that's right or not, but we don't control it. So like there's Tom Wheelwright, who's a rich dad advisor, right? He wrote this book called Tax-Free Wealth, and that's essentially his point. In the whole book, it's like, look, every single tax structure in the world is based to manipulate your behavior. You can't fight the system. You just have to operate within the system. And so the trick is to figure out what they're encouraging you to do and go do more of that.
Very cool. We always talk about. I
dodged your question though, by the way, on cash flow.
You did.
I'm sorry.
You did. Do you have numbers?
No. So look, we make about, after refinance where we pulled all of our money back, we're probably making between $2,000 and $2,500 a month.
Okay, great.
So like $200 a door, basically.
Right.
After refi. And remember, this is after we've got all our money back out, plus some.
Right. Exactly. So we talk about cash flow as like a way to escape the rat race if you're doing that. So it's so interesting to hear from a perspective of when you get to a certain level in real estate, cash flow is not your your horse that drives the engine in a way, because you have so much value add appreciation and you're pulling money out and using it for different deals. It's like, you're paying yourself with the sale of a free and clear property is a totally different ball game than making $500.
Yeah. I mean, there's different strategies, right? Like, I mean, if you need, I mean, there's an argument, and I've counseled lots of people to do this. If you need $10,000 a month, let's just say that's what your expenses are, and you can make, $500 a month on a duplex or something. Well, it's not that complicated, right? You just take 10,000 divided by 500 and you need 20 duplexes and you're free and clear. But cash flow is illusory though. I mean, like in the best month you make 500 and then you need to put a new furnace in and you don't make money for 7 months, right? Because you had to put a $3,500 furnace in, or whatever. So to me, the more cash flow you have, the safer the deal. I partly by accident sort of cut my chops in a situation like I was telling you, where we never took cash flow out of our real estate. So I never got used to living on that cash flow. And as a result of that, I'm kind of comfortable not getting cash flow, which is great, because if I have a month where something goes wrong and we don't get cash flow, it's no big deal. Or if my partners are like, let's save this money up because we might need to do a roof next year, I'm like, whatever, it doesn't matter. I try to live off of, other sources of cash that I get from real estate. Refinance is a perfect example, right? Okay. Like we just refinanced the 19 unit, got back $100,000 each for the three of us. Put $100,000 in your checking account. You don't really need cash flow for a couple of days, right? Presumably just you can live on that for a couple of days. Yeah. And that's essentially what I do. So like I have this like peaks and trough in my cash position. And I've been working on cash flow too, trying to get more predictable, stable cash flow, because it's useful to be able to budget based on cash coming in. So like on our syndicated deals, we have a commitment to our investors to pay them quarterly. Well, turns out I own part of that. So I'm going to get that quarterly cash flow. Right. And so I've done stuff like that. And I've got other things, that I do to sort of generate, like I'll do a flip once in a while to get some cash in. We're flipping a duplex right now. We'll probably make $30,000. Well, honestly, I don't have a lot of personal debt. So if I make $30,000, I don't really need to make money for a couple months. Like it's not that big a deal if I don't take cash flow out. Another thing is the more money you leave in your real estate business, the faster it grows. So like if you guys have jobs, which I'm assuming you do, because you're early in your investing career, like you shouldn't take any money out. You should just throw it all back in.
We had a meeting this week about like just keeping our money in the business as long as we feel necessary.
As long as you can.
Right.
Like until you have so much money coming into your business that you don't have to work, you should leave it all in. Because that's the other thing. When you quit working, and that's the whole thing, right? You're trying to buy back your time, right? And you're able to compound the cash flow you leave in at a rate faster than you can generate new cash, right? So you're compounding all that money. But the other thing is when you quit working, your income from your job is going to go away, right? Mm-hmm. And then you can say, okay, look, I've got all this cash flow that I've never touched. And it's as much or more than what my job income is. So when my income from my job goes away, there's really no transition. Except for you can't grow your business as fast.
Right. So your portfolio has since, I guess, shifted a little bit from the small, like walking through the chronological timeline from a single family and small multifamily to a little bit larger multifamily. Like what do you go after? What type of deals do you go after?
Yeah. Now? I mean, I look for value add because I think actually a former guest of yours, David Grabner, he actually, on a different show I was watching, him taught me this. And I was like, holy cow, this is exactly what I've been doing. And I didn't even realize it. You really can't cash flow yourself to riches, right? So like there's no way to catch up with the amount of money you make through forced appreciation. So if you want to make real wealth, you have to generate equity either by buying right? Like, so if you're buying like a burr or doing, or you're renovating it yourself, stuff like that, you're creating equity. Or you're flipping, that kind of those discrete chunks of money. You can't cash flow yourself to those big chunks of cash. like, because you can't do it fast enough.
Mhm.
So what I do is I try to find stuff where I can create value. So if I find a property that's below market, I might flip it. If I can buy an apartment complex that's mismanaged and I can raise the rents, that's amazing, because I can do like a Burr on steroids then, right? Like I can go refinance in 6 months or a year. I mean, I told you guys off the air that I have 30 units under contract, or maybe I said it on the air, I don't know, but the 30 units I have under contract, both, there's a 10 unit and a 20 unit building. Both of them, I think the market rents they're way below market rents. Now there are reasons for it. One has water issues and, has all sorts of renovation that needs doing. The other one is just kind of in a weird spot, and it's all one bedrooms. It's just been poorly managed, in my opinion. I hope that the seller's not watching now, but at least not until I close, right? But those things, like when I get the rents up, I can go refinance them and get all the money out. And I've even done deals where, like, we did a 16 unit this year in March, actually right on like the first week of the shutdown is when we closed it, where we raised money from. Well, I don't even raise money. We have a partnership where there's a couple of guys that they own a small piece of the company. What they do is they loan money to the company, and we give them like 6% interest, and then the company goes and buys it. So they're basically loaning money to themselves, but we're kind of getting a free ride on it, right? Because we're doing a little bit more of the deal sourcing and stuff, and they're putting the capital into the company. And the deal there, I mean, we got $150,000 from these two guys. I own 40% of a 16 unit. I didn't put any dollars in. We're going to refinance it probably this spring. I mean, the way the market's looking, and how we've raised rents from $550 a door to like $750, $800 in some cases on the 2 bedrooms. And I mean, it's going to be, we'll be able to pay them their $150,000 back, pay that note off, and still own the asset. It'll cash flow like crazy. And I own 40% of a 16 unit. I didn't put any money in.
Super cool to hear. We have not had anyone on the show that talks about they live off the money they make on refinances. So it's like,
oh yeah, I mean, it's not just the refis though. I mean,
no,
like,
I know, but it's
syndication fees and stuff like that. But it's the active side of it that I really believe that's where you. And I think all these people that claim they live off of cash flow, I mean, there might be somebody out there, but unless you have
there's definitely people out there. That
look, if you have free and clear assets, you can live on cash flow. But the truth is, like, you have to have a lot more cash flow than you actually need to live on that cash flow. Like, you can say I need $10,000 a month to live on. Well, then you really need like $30,000 a month in cash flow, because cash flow changes from month to month.
What I guess I'm referring to like pure cash flow after all expenses and all of that stuff.
I know, but people misstate their cash flow all the time.
Totally.
You have vacancies that pop up that you weren't expecting. You have, fires and break-ins and all this stuff that costs money, and it also depends a little bit on, I mean, listen, if you buy like $300,000 houses in the suburbs, the cash flow is more predictable than if you buy $40,000 houses in the inner city.
Sure.
There's no doubt about that. Like, there's a risk measure. I always say, there's people always say that the higher risk assets have a higher return. I don't think that's true. I think that you have to mitigate risk and get asymmetric risk return. So it doesn't matter what field you work in. Like, if you're going to do value add multifamily, or you're going to buy really crappy war zone properties, you just have to have some advantage over the market. That's how you get super ordinary returns. You have to either know the market better, or you need to be like David and do a lot of the work yourself, or you got to be a contractor so you can, save. I mean, you have to have some advantage over the market in general. Otherwise, you're not going to be successful. My advantage has been that I'm really good at putting deals together. I know that I like that deal I just told you, that 16 unit. I don't know anyone else that does a deal like that. I shared that on a show once with a pretty prominent multifamily investor who wrote a book on how to raise private money. And he was like, I've never heard of that.
Well, that was going to be sort of my next question. Like, how do you find, I don't know if you had one.
Yeah, like, how do you find and piece together this deal? But also, just so it's in your head, I do want to talk about syndication and how you are putting those deals together, because people hear that word and they get scared. And I'm hoping you can dumb it down for us so that way people know how to get into it.
Well, they should be scared because there's a lot of risk points in syndication. But yeah, we'll talk about that. So how do I find the deals? So every deal is different. It's all about networking. Every deal is about networking. The 16 unit was literally referred to us by the banker that held the loan for the guy that wanted to sell it. The 10 unit building that we're buying was on MLS. So that wasn't networking. I mean, it was on the wrong MLS though. So that's just outworking your competition. It was on the residential MLS. It should have been on the commercial MLS. So no one was looking for it. I found it. They didn't. I mean, that's
we noticed there's so many times where things are listed wrong, and then that's how you find deals.
That's exactly right.
I've seen so many homes that are listed as single family, they're actually multifamily, and therefore the prices are all screwed up.
You look at the square footage. So you'll see a lot of times where someone will have they'll list it as a 2-bedroom, but it's really a 3.
Especially if it's over like 1,000 square foot.
Yeah, you're like, oh, it's a 1,200 square foot 2-bedroom. That doesn't really add up. Like there must be something going on. Then you want to see that property because you can jump that. And like a lot of times an extra bedroom can add a lot of value in some markets,
cool.
More than the square footage itself. So I mean, that kind of stuff. The 20 unit deal, it was a broker relationship. The 19 and 12 unit were broker relationships. And so it's just telling people what you're looking for. I mean, I target a very specific thing right now. You'll notice that all these deals that I'm telling you about, well, they're all like 10 to like the biggest deal we have is 41 units. And I don't really try not to buy and hold things that are less than 10 now. But we target that because of a specific reason. And there's like a sweet spot in the market, at least where I buy. Mom and pop people are afraid. They don't want to buy $1 million buildings. They want to buy, single families and duplexes. I was like that. I know how they feel. Like it's scary the first time you sign $1 million loan. Now I'm like, whatever. I signed a $5 million loan. Okay, whatever. Like it's weird. But
was that fear just taken away by doing it?
You get used to it and you start to see the advantages of it. And the tax advantages alone of that kind of leverage are amazing, right? And then the amortization gains. I mean, think about this. If you want to hedge against inflation, what's the very best hedge against inflation? It's debt, right? If you owe $1 million and the dollar goes down in value, you pay down $1 million with cheaper dollars.
That's like,
so to me, like they printed $10 trillion this year because of the coronavirus. That's got to cause inflation. Like that's 3 times our gross domestic product, maybe 4, depending on who's counting, right? Like that has to cause inflation at some point. Now, right now they're suppressing it with like super low interest rates and stuff. And they have to do that because they can't pay the debt if interest rates go up because it's so much debt. So the only solution is inflation, and that's the only outlet for the economy. It's going to happen, whether it's this year or 3 years from now or 5 years from now, it's going to happen. And so my goal right now is to borrow as much money as I can. I care. That's like living off of refinance. It sounds weird, but the reality is I borrow, like pile up debt right now because it's cheap and you're going to pay it back with even cheaper dollars in the future.
Very, very cool because I forget who I was talking to, but locking in a 2.9% interest rate on a multifamily that you're at as an investor, just as a normal conventional loan, it's like, what is that going, in 22 years? If let's say you pay it off in 20 years or whatever it is, it's just like your money is so much cheaper in the future. So
it's unbelievable, right? Yeah. I mean, the only thing about that is like, I would say, in general, if rates stay low, which I think they will for at least 5 more years, you want to refinance every 3 to 5 years. If you're in an up market, because your return on equity goes down over time. Like people think, oh, well, equity's, great because it's net worth, and it is great. But if you have like 50, 60, 70% equity in a deal, you're just not getting a good return on that equity anymore because your rents don't go up because you have less debt.
Right. And
also you lose the inflation hedge that we were just talking about because you have less debt. If you have $1 million of the property and you owe $1 million on it and there's 3% inflation, you still owe $1 million and now it's worth $1.03 million.
So would you argue that I guess it depends on what your goals are, right? That all depends on it. But having, 10, 12 units that are paid off and living off that, you're saying you wouldn't do that because you're not getting a return on your money is what you're saying.
Well, you're getting a return. You're just getting a less return, right? Like the more equity you have, the lower your return on equity. So there's a difference between return on investment and return on equity. And people get this wrong all the time. And I'm sorry if you can hear my dog barking. I don't know what she's freaking out. No. I'm glad you can't. That's good. But anyway, so there's this difference there. And as you amortize debt and as your your property appreciates in value, you have more and more equity, but your income doesn't necessarily increase at the same rate. For example, if a property goes up 10% in value and rents go up 10% at the same time, you'd say, oh, well, I've got this, it's the same, right? My return on equity is the same, but it's really not, because your expenses also went up 10% at the same time. So there's a spread that matters, and then spread will go up less fast than the equity build, especially in low cap rate markets like we're in now. So I would say, refinance whenever it makes sense, especially when rates are low, and get long-term debt. I mean, I could go on for a really long time about this stuff because I'm like really geeky on this stuff, but like we're at a point in the market cycle where at some point there's going to be a recession, right? Like we all know that the market's been going up for 10 years plus now. We might be in expansion, we might be in hyper supply, but there's only 4 segments to the market. And we're definitely not in recession right now. And we're definitely not in a recovery. Like we know we're either in expansion or hyper supply. Well, if you're in expansion, the next step is hyper supply. If you're in hyper supply, the next step is recession. Either way, recession's around the corner.
What do you predict happens to the values of homes during something like that? Like, because we talking to a lot of investors who are like, what? I don't claim to know. So that's just how I leave it.
I don't know either. I mean, I don't look, I interviewed Harry Dent, who's like he's an economic forecaster, and he's written like 50 best-selling books. And I interviewed him on 2 different shows, and I like sat and had a drink with him a couple times. And I asked him that same question every single time I talked to him. And he's like, everything's going down. The value's going down. Like the only thing you should hold is cash flowing real estate. But even that, like you'd be better off just having cash, because there's going to be this huge deflationary thing. They can't have inflation forever. Like, and he's way smarter than me. So maybe he's right, but I just don't see it. If I had to predict, I would say tons of stimulus in the market, tons of money getting thrown into the economy that causes inflation, that causes asset prices to go up. Now, will they go down for a little while? Sure, they do that sometimes, but over time, asset prices go up. There's an enormous amount of studies that show that real estate goes up with the general rate of inflation. If you go back to like the 1920s and you bought houses right before the Great Depression started, and then you try to sell them in the middle of the Great Depression, you would have lost money. There's no doubt. If you bought houses in 2007 and you tried to sell them in 2010, you lost money because there's these temporary blips in the market, right? But if you could buy a house in 1950 prices right now, would you do it? Yes. Because it was $2,000 for like a $500,000 house today, right? So
that's what I'm saying. Yeah, almost like we're let's say call it 30 years old. If our goal is to buy real estate and hold on to it, then I don't really care what happens with the market.
I say that all the time. Buy whenever you buy, only sell when it's high. That's my thing.
What is your suggestion to someone maybe in our situation have a couple of units or wants to get in the game? Knowing what you know now, what type of real estate would you buy, and give us like a price, a wheelhouse, and that You're saying, hey, listen, this could potentially launch my real estate investing career to the next level.
Yeah. So listen, what I would do is I would, it depends a little bit on your situation. So if you're newly married, single person, something like that, doesn't have any kids, and you can house hack, you should do house hacking. Like that's an amazing opportunity. Go buy a duplex, live in one side, live for free, get good long-term financing. Because that's the other part about this timing the market cycle. It's actually very easy to time the market cycle if you don't care when you sell, right? Like you buy cash flowing assets, the more cash flow, the safer it is. And one way to get more cash flow is to get really good, attractive financing terms. So homeowner financing. So you do that. And then have long-term financing in place so you don't have to refinance or sell in a recession. And if it cash flows and you have long-term financing in place, you can wait it out. If you bought in 2006, you sold in 2010, that sucked. Bought in 2006, you sell today, you're jumping up and down for joy.
Totally.
So, the safest way to get started is the house hacking strategy, duplex, triplex, or quad, so you can get long-term 30-year low down payment, fixed rate mortgages based on your income from other stuff, right? So it's not the kind of stuff that I get when I get loans. but it's super attractive financing. And, it gives you a chance to get started. And once you do that, you live there for a year or two, you go buy another one, you keep that one, you get another homeowner finance loan. If you just did that like 3 or 4 times over a 10-year period and did nothing else in real estate the rest of your life, you'd retire very wealthy.
Very, very cool. Very cool.
Cool. One more. So, because you mentioned it a while ago and I just want to bring it back up because no one's completely defined it for us yet. Can you define a 1031 exchange and explain how you implemented it in one of your deals? Because I know you mentioned you did that.
So 1031 exchange is, it's a provision of the tax code, section 1031, USC like 82, 1031, right? Section 1031. Basic idea is if you exchange like-kind property, you don't have a capital gains event, which means if you buy a piece of art and then I say, hey, Ryan, right? I have this Picasso and I really, really like your Da Vinci. Like, let's trade. It's not a taxable event. We exchange like-kind property. It's rare art. We change it. Now, if I sell you my Picasso and I paid $10,000 for it and I sell it for 20, I have to pay capital gains tax on that, right? Even if your Da Vinci is worth $100 million and my Picasso is worth $1 million, I don't have a taxable event by trading. Because they're saying, hey, you made a like-kind exchange. The market says you're trading one asset for another. It's the same value. So that's the basic theory behind a 1031 is that you can do that kind of thing. They apply it to real estate in a very specific way, though, in the tax code. You can't touch the money. You can sell an asset. You have to identify a replacement property within 45 days of closing the first one. You have to use a third-party intermediary. So the money goes to this third party. They hold the money for you. And then you have to close on the replacement property within 180 days of when you bought it. So essentially you sell, like in our case, sold 10 houses. Money went to a third-party intermediary. We used that to make the down payment on a 32-unit building. And because our basis in the houses was really low, and we got I think it was like $250,000 for these 10 houses. So they were like cheap Detroit houses. But we only had paid like $5,000 for them, right? So we owed like $50,000 was our basis. So we had this $200,000 gain. Rather than paying tax on $200,000 at the capital gains rate, we're able to roll that into the new deal. It means that our depreciable basis in the apartment complex is $200,000 less than it would have been if we had bought it for cash or used other money to buy it.
Awesome. Got it.
Thank you.
Very cool.
So that's how a 1031. No, by the way, it's a little more complicated than that. So, get good tax advisors, follow the rules, because you don't want to screw it up or you end up with a huge tax consequence.
Totally. We respect your time. We know you have to go. Actually, the last segment of our show is called The Last Drop. Figure out how we got to that. But no, I guess what we do.
Let me tell you about the syndications really quick, because you asked about that. And I do have somewhere to be, they'll get over it, right? Like that's the great part. So the syndications, you had said that the problem with syndications is people get afraid of them, and that's legitimate. See, when you sell a syndication, you're not selling real estate, you're selling a security. Right. And there's rules that define what a security is. But essentially, if you have people investing in a deal as a passive investor and expecting to make a profit through the efforts of someone else, the syndicator, right, then that's a security. It's like selling a share of stock. Right. That's why it's a security. You're not selling real estate. You're selling stock in a company that owns real estate. And under securities law, you have to have a license to sell securities unless you can apply an exemption to it. This is where syndications get complicated. You have to pick an exemption unless you have a broker dealer license or securities license. I don't. Right. So we operate under a couple of different exemptions depending on the deal. You've got to get a securities attorney involved in this process to figure out what exemption you're going to use and then how you can properly raise money. Some exemptions, like what Grant Cardone does, Series A, they register with the Securities and Exchange Commission. They're able to advertise, they can raise money from anyone, but they have to go through a very expensive legal process. And that makes sense if you're going to raise a $50 million fund like Grant Cardone does. On the other hand, if you're going to raise $500,000 to buy a 10-unit building, right? You can't justify spending $50,000, $100,000 in legal fees getting a Series A put together. So you do some different exemptions like 506B or 506C. There's technical differences between the two, probably beyond the scope of what we're talking about here. But the point is, you get a securities attorney to advise you on what the best exemption to use is, and then you follow the rules for that exemption. So some people can advertise, it depends on the deal. Some people can't. Some people have to have a prior relationship with the person. Some people can only take accredited investors. Some people can take sophisticated investors, which is something less than accredited. There's all these different rules, and you really just need to have good legal counsel on that. And there are a dozen or so law firms that this is what they do. I like crowdfundinglawyers.net. I would use them if I was you. I mean, that's who I would use. So.
Great advice. Crowdfundinglawyers.net. Cool. As I was saying, the last segment of our show is called The Last Drop. And we typically ask of our guests, what is some advice that they would give their younger self? I think you kind of mentioned some, but I'm curious if you could maybe recap it if you had to go back, or you could say my 25-year-old self, if I had to give myself some advice, what would you do differently?
Value add multifamily. Like, that's it. I mean, honestly, the best advice I could give anybody who's 25 is get into value add multifamily as soon as you can. I mean, think about this. The 12 unit, the very first value add multifamily, I told you I overpaid for it. It's probably worth, say, $575. I paid $640. So it wasn't a disaster, right? But I mean, legitimately probably paid $65,000 more than it was worth 3 years ago. And now it's worth, let's call it $950, maybe $1 million, right? And it's because we've raised the rents and lowered the expenses. So it's super forgiving. And then also that deal, I got bonus depreciation on it, like $120,000 in depreciation the first year. So it eliminated my income tax on my severance check. So I ended up getting to keep all of my money from my severance or my job because I qualified as a real estate professional, got the bonus depreciation, and and it's been off to the races since then. So it's just an enormous wealth accelerator, and people should get into it as soon as they can.
Great.
Thank you so much.
You guys are welcome. Thanks for having me on.
Yeah. If we really appreciate you coming on. If people want to get in touch with you, if they like your story, they want to hear more,
sure.
You're awesome with the, just your whole background from the lawyer to the perseverance and just building this real estate portfolio. What's the best way people can get in touch with you?
Well, so I have two shows. I think I alluded to this a little bit before, but I have one show called the Old Fashioned Real Estate Show. We just get drunk and talk about real estate. We drink bourbon, old fashions. So they can just follow me on YouTube. That's the most fun way to follow me, because you get to watch me get drunk and talk about real estate, which is about what I'm going to do right when we get off the show here. It's like 8:00 at night. I'm going to go get drunk and talk about real estate with some folks. Probably even drink old fashions. But the other way is we have a private Facebook group called Last Life Ever private group. Listen, I hang out in there. That's actually where my real passion is. I love real estate, but what I love about real estate is it buys freedom for you to do what you want to do with your time. I've done things like this year in February, I went to Africa for the entire month of February. I climbed Mount Kilimanjaro, highest point in Africa. That's what Last Life Ever is about. It's about living the best possible version of your life. And I hang out in that group all the time. So if people want my attention, they can go to the Facebook group and find me, or they can just go to, at Jeffrey Holst on Instagram or my website, jeffreyholst.com. But honestly, the Facebook group is where I hang out the most. And that's where you want to find me.
Sweet. Thanks, Jeff. We really appreciate your time, wealth of knowledge, and hopefully people give you a follow because I love your IGTV stories. They're
thank really you. I appreciate that. Yeah, I know. I've been working on that. I was really bad at Instagram until this year, and now I've really been focused on it since the coronavirus. So
cool.
Thanks,
Cheers,
guys.
Jeff. Thanks so much.